We turn now to the world of reinsurance. The last wave of new Bermuda reinsurers happened in 2005 after Hurricanes Katrina, Rita, and Wilma. Those companies were established with the purpose of filling the gaping void of reinsurance capacity left in the aftermath, not to mention soaring rates. At the same time, a handful of hedge funds began looking into opportunities in the non-life reinsurance market, a move that would blur the line between the world of insurance and the world of the capital markets. And after a difficult 2011, John Andre, Group Vice President, sees hedge funds strengthening those reinsurance routes.
Back in 2005, a lot of the companies felt that there was going to be a pretty significant market turn as a result of the cats of that year. That didn't turn out to be true. Certainly those companies have thrived since then, quite a number of them, and we continue to rate them and have seen their ratings increase in that period of time. I think what we've seen, though, and it's unique about this year, is that the capitalization, despite of the global reinsurers, despite the huge losses last year, is still very, very solid. What we have seen, though, and we've seen some interest in, is the startup of hedge fund-backed reinsurers with alternative investment strategies that are backing a specific type of reinsurance acceptances. Greenlight Re, which we've been rating since August of 2006, has successfully followed the strategy for over 5 years now. In fact, last month, in early January, we released the initial rating of A-. The Third Point Re, which is led by respected reinsurance industry veteran John Berger, and has assets managed by Third Point LLC.
Hedge funds' involvement began through the purchase of catastrophe bonds, which saw growth, and later, when the market became turbulent, they persevered. But the exposure length and risk-reward extremes did not match the long-term strategy of a number of hedge funds. So they began putting up capital for the startup of new reinsurance companies.
Well, they see the ability, the hedge funds themselves see the ability to use their investment acumen in a different way. By taking the skill set, the investment skill set, and combining that with a conservatively managed, specialty reinsurance portfolio. This allows them to benefit of an additional source of earnings from non-correlating reinsurance risks. Additionally, a vehicle like this provides hedge funds with a large source of funds for which a separate investment portfolio can be constructed and managed using the abilities of the existing investment teams. Depending on the circumstances, there could also be tax advantages to the hedge funds who are involved in the side of the business. Frankly, I see interest being raised from the success that I mentioned earlier, Greenlight Re, which has been publicly traded since 2007, and we upgraded to an A rating in the fall of 2011.
Expectations had been that additional hedge fund capital would follow, but market stresses starting in 2006 halted momentum. That is, until recently. But the level of volatility often associated with a hedge fund is not typical of that related to the insurance industry.
Yeah, the analysis certainly is based on track record. It's the skill sets, the future direction of the principals involved from not only the reinsurance side, but from the investment side. And they do have to work hand in hand. A hedge sponsor without the reinsurance leader and the reinsurance team won't see a high rating from us. On the other hand, nor will a reinsurance team without that good hedge fund backed partner. These companies, though, I will have to emphasize, are looking for underwriting niches. They're not going to be global players with multiple offices in multiple countries looking at all kinds of classes. They're looking for some specific underwriting niches inside of the global business of reinsurance. Given that stress test of 2011, the capitalization industry is pretty sound. So there's not going to be a huge market turn, and there's frankly plenty of capacity and reinsurers to handle the current risks in the industry. Where these companies see, though, are those pieces that might fall unnoticed by the larger, more globally based reinsurers.